All right, time to add another country to the ever-growing list of places I'll probably never get to visit. This is Türkiye, or Turkey, depending on which headline you read, because they decided to officially rebrand themselves literally a few hours before I started recording this video. Anyway, Turkey is a breathtaking nation, overflowing with ancient history, rich culture, and some of the most stunning landscapes you could ever imagine. It's no wonder that up until very recently, Turkey ranked among the world's favorite travel destinations, which in turn played a major role in fueling the huge wave of economic expansion the country enjoyed. From the early 2000s through to the mid-2010s. If I'd made this video just 5 years ago, I'd be talking about a rising economic star, a country perfectly positioned both geographically and culturally to act as a bridge between the wealth of the Middle East and the advanced markets of Europe. By gross domestic product, Turkey sits as the 21st largest economy in the world. And when you adjust for purchasing power parity, it climbs even higher to 11th place. That's exactly why it's so worrying that years of poor governance and economic mismanagement now threaten to undo much of the progress achieved over the past 2 decades. For anyone not keeping up with the headlines, the country is currently facing soaring inflation, which is forcing citizens to deal with near-daily price hikes on the goods they need just to get by. The real tragedy here is that this whole situation was almost completely avoidable. A handful of straightforward policy decisions could have stabilized things and set Turkey back on a path to prosperity fairly quickly, but it seems the current administration is either unable or unwilling to take those steps, and there are a few critical reasons why. So, what exactly is causing the Turkish lira to lose value so quickly? What kind of damage is this inflation doing to the broader economy? Why has the government ignored the most obvious solutions to fix it? And finally, could this serve as a warning sign for other nations dealing with similar issues? Once we've unpacked all of that, we'll be able to officially place Turkey on the Economics Explained national leaderboard. This episode of Economics Explained is brought to you by Skillshare, because as another year winds down, if you're anything like me, you're probably setting a new year's resolution that you'll abandon the moment it becomes even slightly inconvenient. Find this happens because learning something new and then actually putting that knowledge to use is difficult. That's exactly where Skillshare comes in. For anyone unfamiliar, Skillshare is a digital learning platform where you can study practically any topic imaginable, guided by professionals and experts who truly know their field. If your goal for 2022 is to avoid returning to an office forever and keep living that work-from-home dream, Skillshare has an endless selection of highly employable skills you can learn from anywhere on the planet, as long as you have a laptop and an internet connection. Even if you actually enjoy your job, picking up new abilities is one of the best ways to keep your brain sharp and engaged. And the best part, if you follow the link in this video's description, you'll get 1 month of Skillshare Premium absolutely free. So, if your New Year's resolution involves learning something new, you'd be crazy not to give it a try. Now, before diving into Turkey's inflation crisis, I need to issue a quick disclaimer. This is an evolving situation that's changing almost daily. Case in point, the country literally changed its name while I was still writing this script, although for simplicity's sake, I'll still call it Turkey, mostly because I'm still not convinced this isn't some elaborate joke. This is also a crisis with serious political implications, which means that some official statements or even data might be driven more by politics than by accuracy. That being said, Turkey is no stranger to inflation. Throughout the 1980s and 1990s, the nation saw inflation rates spike as high as 140%. The first surge came after Turkey piled on foreign debt to fuel rapid expansion during the 1970s. This caused the economy to overheat, while the government ran massive account deficits. The theory was that Turkey could simply grow its way out of debt by turning itself into a major export economy, which, in fairness, wasn't the worst strategy on paper. The real issue was that most of those loans were denominated in foreign currencies, meaning they had to be repaid in the same foreign currencies. This precarious balancing act of borrowing to stay afloat collapsed when oil prices skyrocketed in the mid-1970s. At that point, Turkey was deeply reliant on imported oil to keep its economy running, and even before the price jump, it was barely keeping its head above water. The government attempted to counter the problem with stimulus measures, but all that really did was devalue the lira. And since most of the nation's debt was in foreign currencies, it became increasingly difficult to pay those debts using domestic money that was losing value every single day. Turkey continued to battle stubbornly high inflation, around 60% for the next 2 decades, until a series of central bank reforms were introduced in the early 2000s. Before this overhaul, the Turkish central bank essentially acted as an extension of the government. If the treasury needed cash for public projects, it could simply call up the central bank, and more money would appear. Simple as that. The 2001 reforms fundamentally changed that relationship. The central bank's new primary objective became price stability. It could still help the government promote growth and employment, but only if doing so didn't jeopardize stable prices. One of the biggest changes was a rule forbidding the central bank from buying government bonds directly, the main way governments usually borrow money in places like the United States. This was a huge shift, as it forced the Turkish government to borrow from private investors who were much more cautious about how much they'd lend, especially since the government could no longer just print its way out of trouble. These policies signaled that Turkey intended to play by the rules. No more runaway inflation. No more defaults. With its newfound independence, the central bank got to work, raising interest rates to as high as 100%. For a brief period in an effort to tame inflation. This sharply reduced the flow of new money into the economy and made Turkey a place where investors actually felt safe parking their capital. Unfortunately, once inflation escapes control, there's only so much a central bank can do to force it back into the bottle. After decades of double-digit inflation, the Turkish lira's nominal value had fallen dramatically. This wasn't automatically catastrophic. After all, the Japanese yen is also a low-value currency, but in Turkey's case, the gap was far too extreme. It made international transactions cumbersome and gave the lira a negative reputation. If someone hands you a 10 million lira note, you're instinctively not going to take it seriously. To fix that perception, Turkey introduced the new Turkish lira. In 2005, Turkey introduced a brand new lira, one that was exchangeable for the old lira at a rate of 1 to 1 million. That means if you had 1 million lira, congratulations, you now had one. This reform, combined with a period of political stability, laid the foundation for Turkey's remarkable economic growth over the next 2 decades. Now, Turkey doesn't have massive oil or gas reserves. Sure, there are some small oil fields scattered around, but they don't even cover domestic demand. This makes Turkey a net importer of fossil fuels. But strangely enough, that turned out to be a bit of a blessing. Without easy oil wealth to rely on, Turkey was forced to develop industries that actually created long-term value: manufacturing, tourism, and trade. Through its customs union with the European Union, Turkey gained access to European markets and foreign investment. As a result, it rapidly built a strong industrial base. The country even developed a surprisingly large automotive sector, leveraging its cheap but skilled workforce and its prime location between Europe and the Middle East. And then there's tourism, Turkey's secret weapon. In 2019, before the pandemic, it welcomed 51 million international tourists, putting it ahead of travel powerhouses like Mexico, Thailand, Germany, and even the UK. Tourism is one of the best industries a country can have. Visitors arrive, spend piles of money, and then leave. No need for raw materials or trade deals, just beaches, bazaars, and baklava. And Turkey had it all. Incredible historical landmarks, breathtaking natural landscapes, solid travel infrastructure, and prices that made it a favorite for budget-conscious travelers. It was also a rare chance for Western tourists to experience Middle Eastern culture without stepping too far out of their comfort zone or into places perceived as unstable. So, everything looked great: a strategic location, a diversified economy, a stable currency, and a government keeping debt well below 50% of GDP. But then, things started to change. The trouble began about 5 years ago. In 2014, Recep Tayyip Erdogan became president, campaigning on conservative populism and a strong emphasis on Islamic values, including Islamic finance. Now, under Islamic finance, charging or paying interest is considered usury or morally wrong. To get around that, Islamic banks use creative systems like profit-sharing accounts or rent-to-own loans. For example, if you want a mortgage, the bank buys the house and then rents it to you for 30 years, after which it transfers ownership. Some argue this is just interest by another name. Others say it's a fairer asset-backed system. We'll let the comments section decide. Backed system. We'll let the comments section decide. But here's the key takeaway. In Erdogan's worldview, interest is bad. This belief became crucial starting in 2017, when Turkey's economy started to overheat. While government borrowing was under control, the private sector was taking on huge amounts of foreign debt, borrowing from countries like Germany and the UK to finance the boom. The central bank, bound by its new regulations, was reluctant to print more money, but foreign loans were cheap, and Turkish companies couldn't resist. As with most credit-fueled booms, the good times were really good. The private sector, borrowing spree created enormous wealth and powered Turkey's rapid expansion until it didn't. But like all highly leveraged systems, when things go bad, they go really bad. The problems truly began to surface in 2016, when Turkey's bid to upgrade its relationship with the European Union from trade partner to full member state was rejected, largely due to human rights concerns surrounding President Erdogan's government. This rejection didn't just bruise national pride, it rattled foreign investors and scared off tourists. International lenders began to think twice about sending money to Turkey, and visitors started looking elsewhere for their summer holidays. With those critical revenue streams drying up, many private companies that had borrowed heavily in foreign currencies began to collapse. They simply couldn't service their debts anymore. And to make matters worse, the lira's value plummeted, making those foreign-denominated loans even more expensive to repay. In response, the government did what governments are supposed to do in a currency crisis. It raised interest rates and introduced austerity measures to stabilize the lira. And it worked. Sort of. The currency did recover, but at a devastating cost. Unemployment shot up to 14%, the highest level since the new lira was introduced in 2005. Those high interest rates helped big companies repay their dollar-denominated debts, because a stronger lira made foreign loans cheaper in local terms, but they crushed ordinary workers. For many Turks, it felt like the government had saved corporations at the expense of the common citizen. Erdogan had campaigned as a populist, a man of the people, so this policy shift didn't sit well with his supporters. Then came 2020, and with it, a perfect economic storm. The COVID-19 pandemic slammed Turkey's two most important industries, manufacturing and tourism. Factories slowed, borders closed, and millions of jobs evaporated overnight. Once again, companies struggled to service their foreign debts, and the lira began sliding again. Initially, the central bank did the logical thing. It raised interest rates to try to stop the currency from collapsing. But Erdogan had other ideas. He ordered the central bank to cut interest rates instead, arguing that a weaker lira would make Turkish exports more competitive as the world reopened after lockdowns. When his central bankers resisted, he simply fired them. 3 in a row. Now, to be fair, the logic behind his argument isn't completely insane. Many export-driven economies, most notably China, have deliberately kept their currencies undervalued to make their goods cheaper abroad. But there's a catch. Turkey isn't China. Unlike China, Turkey relies heavily on imports, especially for essentials like fuel, fertilizer, and food. So while exports might get cheaper, the cost of everything else, including life's necessities, exploded. Small businesses and farms simply couldn't afford imported goods anymore, and production ground to a halt. Wealthy corporations, meanwhile, were mostly insulated. They could hedge their currency exposure with futures contracts. Rich individuals converted their savings into US dollars or euros, further accelerating the lira's collapse. Once again, it was ordinary workers and small business owners who felt the pain. So why not just raise rates again and stabilize the currency? Well, there are two main reasons: politics and pride. First, Erdogan's commitment to Islamic finance means that charging or paying interest is seen as morally wrong, even though modern economies basically depend on it. Second, raising interest rates now would mean admitting that his policy of growth through cheap money had failed. Instead, the government insists that Turkey can grow its way out of this crisis, just as it did in the early 2000s, without painful austerity or rate hikes. But that optimism might be misplaced, because despite Turkey's strong fundamentals, a young, skilled workforce, a diverse industrial base, and enormous growth potential, the country's monetary policy is now undermining all of it. And the worst may still be yet to come. Recently, the government unveiled a new plan to restore confidence in the lira. Turkish banks have noticed that almost nobody wants to keep their savings in the local currency, even though lira savings accounts now offer extremely high interest rates. People just don't trust it. After all, inflation in Turkey, even in normal times, still hovers around 8%, which makes those interest rates feel more like damage control than reward. By comparison, economists in the U.S. panic when inflation hits 6%. Because of this, Turkish banks now offer U.S. dollar savings accounts, allowing people to park their money in a stable foreign currency. Most wealthy Turks have already switched, sacrificing higher interest for peace of mind. But there's a dangerous side effect. As more people abandon the lira in favor of dollars, Turkey risks losing control of its own monetary system. For some small countries, this sort of thing isn't a big deal. Take Monaco, for example. It isn't part of the EU, but it still uses the euro. The cost of printing and maintaining its own currency simply isn't worth the trouble for a country that small. But for Turkey, that would be disastrous. Without control over its own interest rates, it would lose one of its most powerful tools for managing growth and employment. And for a nation that still dreams of breaking into the global top 10, surrendering that control is simply not an option. To fight this creeping dollarization, the government has announced a bold and risky new plan: a special savings account designed to protect depositors from inflation. Here's how it's supposed to work. Any money you deposit earns the central bank's interest rate, currently 14%. Then, at the end of the term, the Treasury tops up your account by the exact amount that inflation has eaten away. So if you deposited 1,000 lira for a year, you'd collect 140 lira in interest. And if the lira lost half its value during that time, the government would simply hand you another 1,000 lira, keeping your purchasing power steady in dollar terms. It's certainly creative. Desperate times call for desperate measures, and on paper, this looks pretty clever. Essentially, the government guarantee works like a super high interest rate, without ever calling it one. In our example, it's the equivalent of paying 114% annual returns, but dressed up as a stability measure instead of a panic button. And honestly, it's a great piece of marketing. It could convince Turks to trade in their US dollars, which earn little to no interest, for lira deposits that promise inflation protection and a guaranteed return. That kind of inflow would naturally boost the lira's value, making imports cheaper and easing some pressure on the economy. And at first glance, it actually seemed to work. The lira surged over 50% following the announcement of these new accounts. But then some journalists started digging and noticed that Turkey's foreign currency reserves had mysteriously dropped at the same time. That raised an uncomfortable question. Had the government just bought up its own currency to make it look like the policy was working? We can't say for certain. It's still unfolding. But it's hard to imagine another explanation. If true, that would make this one of the most expensive publicity stunts in history. Still, that's not even the main concern here. The real danger lies in what happens if people actually believe this plan. If millions of Turks flood into these inflation-protected accounts, and the lira keeps falling, the Treasury could owe depositors hundreds of billions of dollars in compensation. And the government would have only two options. Option 1, default on its promise, which would destroy what little trust remains in the system. Option 2, break its own rule and borrow directly from the central bank, effectively printing money to make good on those payouts. And that's where the nightmare begins, because that's the same slippery slope that dragged Argentina and Venezuela into chronic inflation and default. A short-term fix that becomes a long-term catastrophe. If this were 2016, I'd be telling a completely different story. A story of a fast-growing, confident Turkey on its way to high-income status. If this were 2016, I'd also be telling a different story about Venezuela. But now, it's time to see where Turkey lands on the Economics Explained National Leaderboard. Leaderboard rating size. Turkey is one of the world's largest economies, with a GDP of around $720 billion in 2020. That earns it a 7 out of 10 GDP per capita. Once peaking at $12,600 in 2013, it's now fallen to about $8,500, a 5 out of 10, stability and confidence. Despite periods of strong growth, political turmoil and crisis management failures make Turkey far from a safe haven, 2 out of 10. Growth. If we were doing this a decade ago, it'd be a perfect score, but over the past 10 years, the economy has actually shrunk relative to its highs. That's a painful 0 out of 10. Industry. And here's the real tragedy. Turkey's industrial base is diverse, productive, and full of potential. There's no reason it couldn't be a regional powerhouse, if only it had better macroeconomic management. For now, that's a 5 out of 10. That gives Turkey an average score of 3.8 out of 10. 8 out of 10. Yeah, we all knew this wasn't going to end well. But you know what does end well? Learning a new skill for the new year with Skillshare. If you're feeling burnt out after another exhausting year, why not unwind by learning the laid-back Aussie accent in my course? Or if you'd rather build something more practical, coding, video editing, cinematography, you name it, Skillshare has you covered. The modern economy rewards people who bring unique skill, combinations to the table. You never know when a mix of creative and technical skills will give you the edge. If you'd told me 5 years ago that I'd be mixing economics with media production, I'd have laughed. But here we are. You'll never regret learning something new, whether it lands you a job, sparks a passion, or just gives you a good story. And the best part? If you sign up with the link on screen or in the description, you'll get 30 days of Skillshare Premium for free. Thanks for watching, mate, and I'll see you next time.